Commercial finance. It's Wednesday, May 1st, 2024. We're just waiting on Jerome Powell, Fed testimony on what he's going to do with interest rates. We're just kind of waiting on the presentation to start. Right now, 10-year Treasury as of today is right around 466. That's down from 470 as of April 24th. It's up from 436 on April 1st and up from 343 about a year ago. Personal consumption expenditures is one statistic that the Federal Reserve watches. That's at right around 2.7 year over year in March. They want to see 2%. Federal funds rate right now is at around 5.25 to 5.5. Consensus with the banks out there that they'll hold on that. One thing that we want to listen to today to hear if they're going to cut back on selling the bonds. I believe they were doing 60 billion. They may taper that off to 25 billion. And one thing that economists are watching is M2. M2's been going down pretty dramatically. And some economists out there are arguing that it's more of a supply chain issue than it has been a demand issue. Really, the Federal Reserve is trying to squash demand. That's really the only variable they can affect, whereas supply has been, very low as far as home prices due to building regulation, Biden's regulation, and kind of the cutoff of the supply chain with China. We never really or added that supply because of the regulation. You really couldn't manufacture here in U.S., even though we're trying to cut off China from importing goods into the United States. We never could add that supply back again. So a lot of economists are arguing that it's more of a supply issue with inflation. One other thing, price of oil has been going up as of late with all the instability in Israel and Palestine and the Middle East. That's really affected oil prices negatively. So we have a lot of cost push inflation versus demand pull. Really affect net lease finance and real estate in general going forward. The Biden administration is kind of spending money like drunken sailors out there, and that's really going to crowd out lending for private investors that are involved in net lease and commercial real estate. So that, spending, they have to finance that somehow. They'll either have to raise taxes, and I've heard through the grapevine, if Biden wins, that they're trying to lower the estate tax exemption. Right now, I believe it's $12 million per person in a two-family, husband and wife. They each get $12 million. They want to lower that. They want to get rid of stepped-up basis, which really could affect commercial real estate negatively if Biden wins the election. I think that Trump is much better candidate for commercial real estate when you figure the taxes that the Biden administration is figuring on raising. In other words, that's kind of a raise. I believe that Trump would try to lower oil prices. Right now, oil's in the $80 to $90 a barrel range. And I think Trump would try to get that down. That would lessen the cost push inflation. And I think that he would lessen regulation for businesses. So businesses could do more business without as much regulation. We just need a happy balance there, right? And so consumers and small business is kind of the engine that moves the U.S. economy. So it's important that whoever gets reelected really looks into that versus, killing that area of the economy. Okay, we're just waiting on Jerome Powell and his testimony. As soon as he comes up, we can hear what he's thinking as far as interest rates. So we're just holding off. He hasn't come up yet. And as soon as he does, we'll start to comment on what he's saying. There he is, the man of the hour.
My
Jerome
colleagues and I
Powell.
remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially over the past year, while
That's
the labor
good.
market has remained strong.
Good news, inflation's moderating.
Good news. But inflation is still too high. Further progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal.
He wants the 2% mandate.
It is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings, though at a slower pace.
All right, so they're going to do less tapering. We don't want any taper tantrums.
Policy has been putting downward pressure on economic activity.
So that's good, and they're going to keep rates the same. I wish they maybe would have dropped, but that's what we got to deal with.
Better balance over the past year. However, in recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.6% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, was 3.1% in the first quarter, as strong as the second half of 2023. Consumer spending has been robust over the past several quarters, even as high interest rates have weighed on housing and equipment investment. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. The labor market remains relatively tight, but supply and demand conditions have come into better balance. Payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%. Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation.
After talking to some of the commercial agents out there, they seem to feel that the economy is pretty soft. So maybe there's a lag period. Next quarter, we'll feel it a little more because the agents are kind of crying on my shoulder here.
Inflation has eased notably over the past year, but remains above our longer run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The inflation data received so far this year have been higher than expected. Although some measures of short-term inflation expectations have increased in recent months, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%.
So 5.25% to 5.5%. Again, a lot of economists feel that it's not really a demand issue, it's more of a supply chain issue. That's what's keeping inflation up. So there's not much he can do about that.
The risks to achieving our employment
really, it's more of a political issue. We need less regulation for small business, for real estate, and we need to get control of our energy policy, which Biden has just kind of let go pretty much
until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. it is likely that gaining such greater confidence will take longer than previously expected. We are prepared to maintain the current target range for the federal funds rate for as long as appropriate. We're also prepared to respond to an unexpected weakening in the labor market. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We will continue to make decisions meeting by meeting. Turning to our balance sheet, the committee decided at today's meeting to slow the pace of decline in our securities holdings, consistent with the plans we released previously.
That's good news. Less tapering.
Specifically, the
That's
cap on
more
Treasury redemptions will be lowered from the current $60 billion
kind of a dovish situation.
$25 billion per month as of June 1. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we're leaving the cap on agency securities unchanged per month, and we will reinvest any proceeds in excess of this cap in Treasury securities. With principal payments on agency securities currently running at about $15 billion per month, total portfolio runoff will amount to roughly $40 billion per month. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach its ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings.
That should keep rates, like long-term rates, possibly a little bit lower because they're not selling bonds as aggressively as they were from those bonds they bought in 2009, right?
Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
So there you go, keeping rates steady, 5 1/4 to 1/2, and less tapering. So that's good news. But again, we need less regulation. We need better energy policy. With all the spending government's doing, that's going to crowd out
clearly that policy is restrictive and is
private lending. It's going to cause higher rates. We need to get control of our budget. There's a lot of issues, but let's listen in to a couple of questions here.
The demand side of the labor market in particular, but it's cooled from its extremely high level of a couple of years ago. And you see that in job openings. You saw it, more evidence of that today in the JOLTS report, as you'll know. It's still higher than pre-pandemic, but it has been coming down both in the Indeed report and in the JOLTS report. That's demand cooling. The same is true of quits and hiring rates, which have essentially normalized. I also look at surveys of workers and surveys of workers and businesses and ask workers, are jobs plentiful, and ask businesses, are workers plentiful? Is it easy to find workers? And you've seen that the answers to those have come back down to pre-pandemic levels. You also see in interest-sensitive spending like housing and investment, you also see that higher interest rates are weighing on those activities.
So housing and investment, commercial real estate, that's weighing on investment.
So I would say that we believe it is restrictive, and we believe over time it will be sufficiently restrictive. That will be a question that the data will have to answer.
So as a follow-up, if inflation continues running roughly sideways as it has been, the job market stays reasonably strong, unemployment low, and expectations are anchored and maintained, would you disrupt that for...
Expectations are not anchored?
Or anchored.
Or anchored.
Stable, roughly. Would you disrupt that for the last half point on PCE?
You know, I don't want to get into complicated hypotheticals, but I would say that, you know, we're committed to retaining our current restrictive stance of policy for as long as is appropriate, and we'll do that.
So again, Fed's watching the personal consumption expenditure That's coming in at around 2.7%, and they want 2%.
I wonder, obviously Michelle Bowman has been saying that there is a risk that rates may need to increase further, although it's not her baseline outlook. I wonder if you see that as a risk as well, and if so, what change in conditions would merit considering raising rates at this point?
So I think it's unlikely that the next policy rate move will be a hike. I'd say it's unlikely.
Well, that's good. Unlikely a rate hike.
This is really what I just mentioned, which is how long to keep policy restrictive. You ask what would it take? I think we'd need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time. That's not what we think we're seeing, as I mentioned. But that's something like that is what it would take. We'd look at the totality of the data, answer to that question. That would include.
Well, there you go, Jerome Powell's testimony here on Net Lease TV. I'm looking forward to seeing you guys out at ICSC in Las Vegas. I am flying in on Saturday, May 18th, and I'll be there through the following Wednesday, the 22nd, near the 7-Eleven booth. We're coming into the election. It's a huge year. November's not that far off here. And I'm going to say I hope Trump wins with all the negative things that'll affect commercial real estate.
Thank you, Chris.
It's not beneficial for us to have a Biden win. Thanks again, and thank you for watching Net Lease TV. Thanks again.